Hi everyone, my name is Zack Oliva, Managing Partner at Oliva Gibbs, and today we have Josh Young with us. Josh is the Chief Investment Officer and founder of Bison Interest. Josh has built his career investing in publicly traded oil and gas securities, and he has over 15 years of experience in investment management. He's the author of numerous articles on oil and gas investments, and a guest speaker at various energy industry conferences, as well as on CNBC and many other media outlets such as the Wall Street Journal, Al Jazeera, Bloomberg, Barron's, Reuters, and others. In 2022, Josh was shortlisted for Best Equity Hedge Fund under 500 million, and he has been interviewed in Barron's, and recently in 2022, he was actually the only oil and gas public equity investment manager to be recognized in Hart Energy's 40 under 40. So today, I think this is the third year that we've done this. Josh is going to share his outlooks on the market in 2024, specifically related to the oil and gas sector.
Thanks, Zach, and thank you all for joining us. So I'm going to do a quick overview of the oil and gas industry from the perspective of Bison. Before getting into it, here's our disclaimer. Please review it carefully. We are not offering or soliciting any securities or making any investment recommendations through this presentation. So here's a little about me. So I found it's helpful to just sort of benchmark when I look for experts in various areas, and when I look at management of companies I'm looking at investing in or even getting advice from. I found it's helpful to look at their track records and to be able to sort of calibrate what to expect from the track record. And frankly, my track record on macro speculation is not amazing, but Bison has done well relative to its benchmarks and relative to investments in the public oil and gas space, as measured on this chart. Again, this is not a solicitation. I find it's helpful to look for this sort of information when I'm looking at experts and trying to learn about something. And so since it's a private investment advisor, I thought I'd just share this to be able to help people calibrate it. And definitely, I'm still to be held account for various incorrect macro predictions and prognostications, and my short-term crystal ball is still broken. So we actually had this slide last year, and I think it's interesting that people are always really worried about the next recession. And last year, around this time, there was a near consensus that there was going to be a recession within 12 months among economists and in the Fed dot plot and so on. And it turned out that there was not one. And there have been significant gains in the general stock market, and certain oil and gas stocks have done very well. Others have done poorly, but there have been significant opportunities in the public markets as well as in sort of the broader investment universe. And so I think it's important to remember in good times and in bad times that it's better to look at fundamentals than it is to try to guess when the next downturn is going to be. And Peter Lynch built an amazing long-term track record with that approach, and it's good to remember. I guess the one other thing is that they say that that bears sound smart and bulls make money, and that hasn't 100% been the case for oil and gas for the last decade and a half, but it has been true for the general market, and I think it will be true again for oil and gas. So getting to the root of the oil and gas macro world, I tried to think of just a few charts that would really show where we're at to be able to understand where we're going. And so I think the biggest single factor in the oil and gas world is the significant amount of underinvestment in long cycle exploration and delineation. And so one of the proxies for that is just total spend. And in this case, we're showing US E&P spend, but the reality is global is sort of similar. And looking back from 2014 to 2022, you see that investment's down substantially. We're starting to see investment tick up in 23 and tick up even a little more in 24, but there's there's this enormous gap. And I was listening to a famous mining speculator talk, and he's actually gotten interested in oil and gas recently. And he was saying that every day there's $1 billion of underinvestment in oil and gas, and that essentially is cumulative and essentially compounding. And so when you look at this chart, again, 2023 is up, 2024 probably up a little more, but there's this enormous spending deficit. And that does have consequences, including higher prices right now for oil than we've seen in most years in the last decade, and the potential for much higher prices over a long period of time.
Is your sense that that spending is coming from completely new entrants to the sector, or is that spending coming from folks who maybe made bets elsewhere and have decided to re-enter the sector?
So I think it's mostly from companies that are already in the sector, just ramping up their investment.
Okay.
So some of it's going to be from the oil majors who were diverting funds into alternative energy and mostly losing that money, as you can see from the variant returns for the Shells and BPs of the world versus the Exxons and Chevrons. But even the Exxons and Chevrons are diverting capital away from alternative energy back into oil and gas. And that's where you're seeing the capital tick up a little bit. But there's still this enormous gulf. So what you really need, I think, is for oil and gas companies to reinvest a lot more, which requires much higher share prices and more rewards in the market for investing more. Probably needs higher prices in order to do so. But then you also need returns to be so good that you have endowments and foundations and pensions and so on feel the pain from not investing and overcome their moral and other dogmatic issues to invest in oil and gas again. So there's this gap still in the hundreds of billions of dollars a year that needs to get filled, and the longer it takes and the bigger the gap is, the higher oil prices go and the longer they stay. So we can see that in another way, which is looking at drilling rigs versus the price of oil. And oil is a little over 80, the drilling rig count is a little over 600, which is amazing considering the history where if you look back, pre-2014, you had a rig count close to 2,000 rigs. And yeah, drilling rigs are more productive in terms of more feet drilled per day, but wells are not. And so if you look at it on a days of rigs spent versus oil produced, we're not that much more productive today than we were a decade ago, even though we're drilling a lot faster. So a typical rig these days, high spec, you might actually drill 3 times faster than you were drilling 10 years ago, but you're drilling a 15,000-foot lateral and getting, in some cases, 30%, 40%, something like that, more production than you got from a 5,000-foot lateral 10 years ago.
So do you think that rig count is still the best indicator of activity to use for the sector?
I think it's one of the best. Another is the frac spread count, and then you can proxy for that by looking at the drilled uncompleted wells. And my choice for this presentation was to show a smaller number of charts rather than a larger number to try to not overwhelm folks and to focus them on what I view as the most important indicators for the sector. But what I can say is that the drilled uncompleted count has collapsed. And what that means is that you need a lot more drilling rigs in order to be able to get production to start growing again. We've actually seen production shrink a little bit. And so the drilling rig count, I think, is, again, one of the most important indicators, whereas the frac spread count, because of the depleted drilled uncompleted inventory, matters a little less.
So does the lower DUC count correlate to better prospects for oilfield services?
Yes.
Okay.
Yeah, things look great for oilfield services. I've been deploying incremental capital, even though I'm focused upstream. I've been deploying incremental capital into oilfield services, and I think there's a decent shot that we actually overshoot to the upside at some point. The rig guys and some of the oilfield services guys call it rig-mageddon, like a rig Armageddon. There are enough rigs to get most of the way back up, but not all the way if you see convergence on this chart. And I think there's a decent chance that you see utilization a lot higher 2 years from now and rig rates a lot higher. And when you look at the propensity to spend on the upstream side, it really is driven by rates of return. And rates of return on most of the oil wells that are being drilled are very high. So the constraint right now isn't return driven, which means that you can have much higher drilling rig rates and actually still have a similar or higher rig count today. There's other issues like a low natural gas price, like takeaway capacity issues, inclination to not flare, returns to investors rather than spending money on drilling. So there's a lot of objections to spending to ramp the rig count.
Does this chart look similar to in Canada?
Yeah, it's similar, although in Canada it's a little different because there's more low spec rigs that are going and drilling these heavy oil plays like the Clearwater. And so there's a lot of those rigs that are getting deployed, but the reality is that those are actually not contributing a lot of production, and it sort of makes it a little bit, if you look at it on a horizontal rig basis, it looks really similar in Canada to the US.
Gotcha.
So one other factor that's really important, so we've done a ton of work on OPEC plus spare capacity and the limitations there at Bison. It's helpful to find other folks that have done similar stuff that are also well known. Arjun was the Goldman Sachs oil analyst for a number of years, and he famously called the last super cycle in oil going from the early 2000s to 2014. And he also sees something similar to what we see at Bison. He put together this chart showing how rare it is for Saudi Arabia to produce 10 million barrels a day. And there's this idea that the Saudis could produce 12 million barrels a day, and supposedly they're building towards spare capacity or to be able to get to 13 million barrels a day, but they've almost never produced more than 10. And so this matters a lot because the way you get to that sort of rig-mageddon, like hundreds more active rigs in the US, the way you get to land values rising in the way that we've been seeing, but even more extreme and way more deals and way more competition on deals and so on, is through OPEC ultimately exhausting their spare capacity. And I think this is not a consensus view. This is a strong variant view from Bison and maybe Veriton and maybe a few other folks. And that's it, that we're actually very close to the spare capacity limit at OPEC. And as we achieve oil demand growth over the next few years, with the low investment in the sector, with low rig count and so on, you're going to end up with a deficit, and that deficit can't be met based on the history for Saudi Arabia and other OPEC countries. So this is probably one of my favorite charts in the oil and gas world. It's from JP Morgan, and it's from their latest super cycle update, I think fall or winter of 2023. And basically they show their projection of global oil supply growth versus global oil demand growth. And what's been interesting is since JP Morgan put this out, I think their initial one came out in 2020, just before COVID. So it looked really bad for a minute, and then it's actually looked really good since then. Demand keeps actually ticking up despite consensus expectations of slowing or peak oil demand, and supply keeps disappointing. And so they've been really on point. And I think it really just makes sense to think about where you expect oil to come from and what it means to have this large and growing gap. This is where when you start thinking about every day there being $1 billion of underinvestment in oil and gas, you start to understand why some of these larger companies that are seeing this in their oil trading operations and their international operations, go in and pay tens of billions of dollars for oil assets in deals that many insiders are trying to understand why. They pay higher and higher prices. And some of these companies, you can say, oh, they're foolish for that, but they see this and they see it in their operations and they see it in their competitors' operations. And so I think this is, you want to have this, if you're in the oil and gas industry, up on your wall and just sort of track over time how supply grows versus how demand grows.
My partner Brad told me that if you want some really good reading material, go to the Wikipedia page for peak oil, and all of the predictions are laid out on that Wikipedia page. It's really interesting.
Yeah.
So in this gap, who are the winners? Assuming that this gap is true until 2030,
Mhm.
who are the winners inside of the gap?
Um, oil producers,
Okay.
oil field services companies. I mean, I think no one really expects this gap to actually fully unfold because as we progress, so we're actually in a deficit situation right now. There's a global inventory decline so far this year to the tune of about 150 million barrels, which is pretty substantial.
Right.
And it's it's only mid-March while we're doing this, so there's a lot more damage that can get done to global inventories. To the extent that this continues as modeled or as shown here, you're going to end up with way higher prices way sooner, and that should suppress demand a little as well as economically incentivize substantial additional supply activity. So you won't get, it's very unlikely that you get to this size gap by 2030 because you'd be dealing with like $500 oil on an inflation adjusted basis and you'd have economies crashing.
I think the first time that we did this was in 2020, maybe 2021. This this market update. You're definitely a value investor because these slides have not changed that much, which I think is the mark of a great value investor. And also, you have not been wrong in your theory of underinvestment. And I think since we first started talking about it, it's become even more apparent to me how correct you've been on that, and a lot of analyst reports, banks, and industry publications have backed that up. But my question is, what has been the biggest surprise to you? So you've had, the theory has been the same over the last few years, but what's been the biggest surprise to you about how this has played out?
So two things. One, shale has actually been more resilient. So I was among the folks that thought that U.S. shale was peaking a couple of years ago, and I was wrong. And what's happened is that shale productivity has managed to continue to improve through incredible adversity and despite labor limitations and capital limitations and so on. And so where I would have thought that shale would have peaked at sort of, let's say, 12.5 million barrels a day, we got to 13.3 million barrels a day as sort of a peak last year. So I was off by 600,000 barrels a day, 700,000 barrels a day, and I was off by that because I underestimated shale productivity improvements. My assessment now is incorporating those improvements and looking aggressively at various oilfield services and technology companies to see where those next technology improvements would come, as well as looking at various emerging shale plays in various geographies to try to see what I might be missing, what the JP Morgans of the world might be missing, to see where else. When you're wrong, it's important to acknowledge it and then to try to be proactive to not be wrong for the same reason twice.
Have you been surprised at all at how long it's taken capital to return to the sector based on this obvious gap?
I had a conversation with someone about this recently where we were talking about the, Bison had a large backer that pulled their money in November 2020, and the same stocks. So we trade, but we tend to hold things for multiple years. And the same stocks, if we just hadn't traded them at all, that portfolio would have been worth 10 times as much 2 years later. And you don't see that allocator out there in the news for allocating money to oil and gas. And so if missing a 10x isn't enough to get folks back, and they certainly haven't called us again. So if that's not enough to get people back in, it's clearly not all about the money. And so I think what you need is for expectations to be reset. And the way you reset them is through just disproportionate returns. And so it's hard to show. I guess this chart is sort of where you see where those disproportionate returns can come from. But if you don't attract enough capital, and if you can't get the oil majors to invest even more than they're investing, and if you can't get the endowments and institutional allocators to allocate to the space, and you can't get the ultra wealthy family offices and so on to invest, you're going to end up with this supply gap, and you're going to end up with $500 or $1,000 oil.
And that's going to happen no matter what. I mean, I think that the one thing that has been interesting to me over the last few years has been with all of these new renewable technologies coming out and renewable projects, they don't meet, and I think don't even make a dent into the country's energy demands. And so it's like you can pour as much money as you want into these new technologies, but this gap is going to continue because our energy needs for oil and gas are so high, right?
Yeah, I saw a statistic where if you look at the total global spend on alternatives, it's something like $5 trillion in the last, was it 5 or 10 years? And if you look at that versus the percent of energy that fossil fuels are consuming or contributing, it's gone from 82% to 81%.
I know.
It's with 5 trillion. And the actual total amount consumed has gone up, not down. So, you know, it's not really a money thing per se, because the dollar amounts are so staggering. So the true believers will say, okay, wonderful. So if it costs 5 trillion for 1%, great, let's go spend 500 trillion. But I think they sort of missed the point that there's actually diminishing economies of scale in some of these things. If you look at like California grid, for example, where they have negative power prices during the day because they overbuilt solar, putting in more batteries is actually not really helping at this point because they end up depleting real fast and end up getting used up. So their charge holding sort of falls really fast, and you end up with this need for actually more natural gas, not less. And adding more solar has actually just forced out nuclear power and is forcing out other sort of base load. So you end up actually potentially having more emissions, even if you exclude the emissions from manufacturing solar.
That's crazy.
Yeah. So I like this one. The stock traders and other public equity folks might like this a little more than the lawyers and private deal folk. But world oil demand is breaking out, and what that means from a stock perspective is that it had been sort of in a trend or in sort of a down or flat period, and now it's back to sort of a growth phase. And there's different ways to show this.
Is that COVID, the blue line?
That's an era of essentially from the 2019 peak till where you got to that sort of recovery period in 22. That's essentially the sort of stay flat. Over several years, there were various folks like Kathy Woods and so on who were saying, hey, like oil demand has peaked, it's done. And the reality was oil demand was forced offline by governments, and as individual actors were better able to control their own activities, they started using more oil. And then, I thought about overlaying jet travel, which is up substantially from pre-COVID levels and is growing really fast. But it's one of those things where you look at past periods where demand has declined, and you see the growth after, and it's pretty remarkable just how quickly demand has grown from the lowest points during COVID, but then also when you look at demand growth historically after these pullbacks, you see pretty steady, actually pretty rapid growth. So, oil demand has not peaked, and it's pretty amazing when you think about the world growing oil demand by 1.5 million to 2 million barrels a day every year.
So one thing that I read in the news recently is that the U.S., and I guess the article was about the U.S. and China, and how the population is set to decline in those two countries. So does that have any effect on this world oil demand forecast?
So as people come from countries where they consume 1 or 2 barrels of oil per person per year, to countries like the US where they consume 21 barrels per person per year, they might not catch up to your or my oil consumption, but they might go from 1 to 5 or 7. And so you're ending up with this demand replacement of, let's say, Americans who aren't having kids. Their kids are essentially getting replaced to some extent by immigrants who may not be using as much oil, but are using a lot more than they were using in their home countries. So at least from a US perspective, that's overcome the demographic constraints, at least in the last few years. From a China perspective, it's a really interesting question. And
so is immigration good for the oil industry then?
Oddly, yes. It's one of those weird things. The more you learn about these things, the more, when you just look purely agnostically from a values perspective, you just focus on the actual consumption numbers or consumption data. It's pretty interesting what you see. It's actually one of the reasons why we didn't have this recession in the last year, is that I think the per capita, the denominator that they're using on a per capita basis has been wrong. And so if you have more people, you can have less per capita growth, but more top line growth because you have more people consuming and producing and so on. And so you end up with a better economy than people thought, mostly because there were just more people. So China, very interesting. We thought about putting in a 2023 number, and the problem is that there's a 1.5 million gap, barrel per day consumption gap in the consensus numbers between the different sources. So people don't really know if China used 16.5 million barrels a day or 17.5 million barrels a day in 2023. When we did this last year, we didn't really know if China in 2022 had consumed 13.4 or 16.4. So at least the uncertainty band is narrowing. China, it looks like, got to a consumption level of 18 million barrels a day for a month last year. So in September, it looks like they got to 18 million barrels a day, September 2023. What you see on this is, it would be really interesting, I think, to actually show this overlaid versus the population in China, because the Chinese population is actually probably declining a little, like you were referencing, but it hasn't been growing for almost the entirety of this chart. Right, going back to, let's say, 2007, 2006, the population in China was basically peaking at that point. So the almost doubling of the consumption is not related to the population exploding. I think people look at this and think, China's population is 2 or 3 times or wherever it was in 2000. The reality is it's up a few hundred million people, which is a lot. But on a percentage basis, it's up, let's say, 30%.
Is it related to like the modernization of their economy?
Yeah, they're going through an oil consumption S curve, they call it. And so actually, even with low or negative GDP growth on a per capita and total basis, they're actually seeing oil consumption growth.
Do you know, and you may not know this, I'm just asking you a question off the top of my head, what percentage of China's energy demand is fulfilled by oil and gas versus like coal?
I don't know it offhand. I know that Chinese coal consumption soared over the last few years, and their air quality has been horrible.
Right.
And during China's like super growth periods in the early 2000s, there were a lot of news reports and so on about their air quality being terrible. They've gotten better at cracking down on those news reports,
sure.
But their air quality's gotten worse. There's a big push to improve it, and that includes producing more natural gas domestically. There's a pipeline from Russia that's bringing in a lot of natural gas. There's liquefied natural gas from the US and other sources coming in.
Are they a net importer?
Oh yeah, substantial net importer.
Oh really?
Yeah, substantial
from
importer.
India, Russia,
China.
Yeah, Africa.
Of which of those? Of coal from Australia and various other sources. Of natural gas from global sources like Qatar and the US. Of oil from most of the Middle East, but also the US and various other sources. Yeah, it's a really interesting, when you look at this, I think next year we'll show this versus China's population. We'll just use their official figures because people can deduct however much they want from the China's population, like you were alluding to, probably started declining a couple of years ago. But it was peaking for a while. Like the growth rate was ultra low for a number of years before it peaked. And it is remarkable just how much oil demand China is incurring, and how much their demand has grown even with their real estate activity collapsing. And so 2024 is a really interesting, 2023 was an interesting test case. You had very low property development activity levels, and you still had record high oil demand in China. A lot of it's from flight stats, chose not to show that chart, just again, try to limit it to the few most meaningful ones. But when you look at the flight stats, you understand, jet fuel is booming, and that's going to drive a lot. That's going to drive a lot demand perspective going forward, both directly and when you fly somewhere, you then take a cab or an Uber, and then you engage in oil-intensive activities. So a big question on all this is, so what? And again, some of the macro prognostications I've had have been off, some pretty substantially. I think one of the takeaways from this is that there are amazing investment opportunities in the oil and gas space, and that it makes sense for companies to deploy capital investing in oil and gas. And I think it makes sense for a variety of investors and allocators and so on to seriously consider oil and gas as an area to focus on and deploy capital into. And so I can show the historic underinvestment in oil and gas directly, but when you look at the equities, it's eye-catching. And if you look at similar snapshots to this 2014 to 2024 10-year timeframe, in past periods when there's been this level of underperformance for oil and gas stocks, there's been periods of this level or more outperformance of oil and gas stocks in subsequent periods. Again, alluding to value investing, I think there's a huge recency bias in public markets, but also in private company capital allocation and in private equity firm capital allocation, as well as by asset allocators that make money available to private equity firms and so on. And so I think it makes a ton of sense for folks to be buying oil and gas assets, to be buying minerals, and to be buying oil and gas equities. None of this is a specific investment recommendation. I may or may not own securities in any of these things. The idea is just, this is, when you see something like this, either it's going away or it's one of the best investment opportunities of your life. And based on that JP Morgan chart, I'd say it's probably not going away. Right. And that China demand trajectory despite the population peaking. So I think it's really interesting. This one's also pretty interesting. It's another way of showing the same thing. Oil and gas companies are making a lot of money, and they're not getting rewarded for it in the stock market. These numbers, this is through 2022. Again, data quality issues for 23. We're getting through the end of the reporting season, so it's a little better for 23 at this point, and it looks pretty similar. Energy companies might have made 9 or 10% of the earnings for the market in 2023, and they're 4% again of the market capitalization. This tells you, this is actually there's some writings about Buffett from his earlier days where he was more open about his investment process. And this was one of the macro things he would look for, is industry earnings versus industry representation in market capitalization, similar to his test of market capitalization versus GDP. So this is a sort of Buffett test.
Indicator of the S&P.
Yeah, and of market opportunity. And so Buffett's gotten a lot of flack for buying a lot of Oxy stock. It's not done as well as other large caps, and it's relatively expensive versus other sort of similar producers. It has more upside to higher oil prices than some of its competitors, but on a run rate basis at like $75 oil, it trades at a higher earnings and cash flow multiple. And this would be, if you use this as a Buffett test for should I invest in oil and gas, the answer would be definitely yes. And then if you listen carefully to what Buffett and what Munger had said before he passed, this would explain owning a large oil levered producer.
I also recall when we went to the Berkshire Hathaway meeting 2 years ago was when he talked publicly, I think for the first time, about the Oxy investment. And he said it was also the position size that he ended up with Oxy was also due to the volume on the stock, because he told his broker, like, just go buy 15% of the daily volume, and then they ended up with almost half of or I think a quarter of Oxy at that time, which is crazy to see that much, I think, volume trading on a company of Oxy size.
Yeah, it was remarkable, and they did that with Chevron too, and they ended up owning just, they were surprised how much, and they've subsequently bought a bunch more Oxy. So, yeah, it's a little more expensive, but it makes a lot of sense. So there's something that Buffett talked about at that annual meeting for Berkshire, as well as at prior ones, where he talked about how if he were running a much smaller amount of money, because Berkshire has hundreds of billions of dollars to deploy, he thought he could compound money at a much higher rate. And so I thought I'd share one example of a company that we're invested in at Bison. So I own Vital Energy stock, and I'm not recommending it. I'm just sort of sharing one sort of tangible way that I've applied some of the macro work that we've done at Bison to a position that Bison holds. And it's also a good segue to talk about transaction activity and sort of what's happening in the oil and gas industry. So Buffett has what he said repeatedly, and it's sort of self-deprecating that, hey, there's way better opportunities on the small side than the larger side, and it's really hard to beat the stock market buying large cap stocks and buying whole companies. And his view is that it's much easier to beat the stock market on the small side. I don't think it's easy to beat the stock market sort of no matter what, but I thought I'd share a smaller company. So one of the interesting things about what's been happening in the oil and gas space is this sort of race to pick up remaining private oil and gas assets in the core of some of the highest return areas to drill for oil and gas in the US. Mm-hmm. And so you've seen companies like Oxy, which is interesting again from a Buffett perspective, because likely they had either direct or indirect approval from Buffett for their Crown Rock acquisition at $70,000 per barrel of oil equivalent per day, as well as various others like Exxon buying Pioneer for nearly $90,000 a flowing barrel. It's really remarkable when you think about this, given where we've been recently, where transactions were at a lot lower level, and then where some of these private transactions or some of the smaller transactions are still happening. So like that saying from Buffett, I mean, you can even see it on this chart, where if you wanted to know what the smallest deals were, you could just look at the lowest valuation deals. And again, not that these things are identical and the price paid per flowing barrel is only one metric. But I think it's really helpful to think about these things outside of the sort of general industry narrative of, oh, XYZ company has like good land or bad land, or a lot of inventory or a little inventory. I think it's helpful to consider a variety of different valuation metrics. And I think this one it's sort of the simplest and the easiest, which is how much production are you getting and how much are you paying for that production. And it's the easiest to show the substantial value uplift, where you're seeing higher and higher dollar amounts paid and also larger and larger deals over time. And you're seeing this despite oil prices over this time frame actually falling quite a bit, and natural gas prices falling quite a bit, and then sentiment towards the space falling as well. So I think
the highest valuations are the biggest deals.
Yeah.
Interesting.
Yeah, and again, I think there is this risk, and they're starting to maybe speak about it a little more directly, but it's been sort of indirect so far, that they're sort of running out of deal opportunities. And so there's this indication. Obviously, every acquirer talks about how amazing their deal is, and they all talk about how great their existing inventory is, and so on. But it's pretty interesting to listen carefully to what they're saying, as well as what they're showing via their acquisitions. This chart just shows relative to the market cap, debt adjusted for Vital, how much upside their stock has relative to these deal valuations. And again, this isn't meant to be a valuation of Vital. There's a lot of different statistics on companies that would tell you if they're more valuable or less valuable. The point is, on one metric that's the easiest to measure, there's broad dispersion in valuation, and as companies get bigger and as there's sort of more production, there's room for more upside. So you could pick another small cap or another mid cap in the Permian or in various other basins and see more or less upside depending on how they're valued on a variety of metrics. But there is this tilt towards higher value for bigger, and there's this sort of rush towards bigger transactions. You can see how many very large transactions have happened just in the last few months, despite what's actually historically been a pretty quiet time of the year from a transaction perspective.
What's been your biggest surprise when seeing, this chart and these valuations play out?
So historically, this one's been weird to me, because historically, when you see this sort of trend, you see the equity price appreciate relative to the deal price. So it hasn't happened yet. So we spent a lot of time on this and talked to management extensively and talked to the people that don't like it and that do like it and so on. And I think there's a lot of complexity right now in oil and gas capital markets where Vital has grown through acquisitions, and they've funded those acquisitions partly through debt issuance, but also partly through equity issuance. And there hasn't been a strong secondary market to absorb the shares that they have given to private equity funds to buy assets. So even though they trade at a 400% discount, essentially, that Endeavor was bought at a 400% premium on dollar per barrel produced per day. And again, there's different metrics, and some would show a lower premium, still a premium on an inventory value basis and on a reserves basis and so on. Still, actually, reserves a large premium, but you would historically have seen the stock trade up towards those values. And I think it's actually one of the things that's kept some of the public companies from getting bought out. And where you see some of these smallest premiums, it's been public company buyouts. So Permian Resources bought Earthstone, which had very low value inventory and was sort of a complex deal. That deal was doable because Permian Resources issued their own public equity, which was undervalued, to buy a more undervalued public equity. Similarly, recently, Apache, or technically APA, is buying Callan, and APA also was at a relatively low valuation, and they bought Callan, which was at a slightly lower valuation, and so they were able to get that deal done. But it's been very challenging, I think, for the oil majors to go buy the public companies, even if they can get them at a discount to the private companies, because there's this just large gulf, and the public companies appropriately aren't willing to sell for cash at a huge discount. And then if they're going to take stock, they want there to be a lot of upside in the stock. That's from a valuation perspective for the stock that's being awarded. So that's my theory, but this is a very unusual situation where historically, if you see this many deals and you can underwrite the inventory and underwrite the production, and frankly, it's sort of funny, there was NVIDIA AI Day yesterday, and they were so excited about these new GPUs coming out and so on. And there's very few companies that actually have effectively deployed AI in their operations.
Yeah.
Vital was an early adopter, and so in the last couple of years, their operating costs have fallen, and they're sort of better at tracking wells that go down, and their performance relative to their own historic performance has improved a lot, and relative to the industry, their ranking has improved a lot. And people hate the idea that they're using AI for this. And where most companies, when they talk about AI, their stock goes up, Vital stock has gone down. And so I like this from a sentiment perspective. I want to buy stocks like that, because when people hate it so much that the thing that's the hottest with a company that's among the highest valuation and largest market cap in the world is doing something to sustain their high valuation and market cap, and you do it and you get sold off for it and people mock you for it, even though you have actually real financial and operating results from it.
Right.
I mean, again, they're not alone. There's many other companies who are doing it, but their operating performance has improved measurably, both relative to their own historic performance and versus the industry from doing it. So, it's one of these just weird things. You see these sometimes, and sometimes they correct and sometimes they don't. So this isn't a promise that this will achieve a 400% return. But in my career and at Bison over many years, where we've bought stocks like this, where we've held them despite them being very out of favor and various narratives that are just sort of not true, sort of getting disproven, there's been a lot of upside. And the thing we didn't show, we probably should have, it was just hard to get the metrics on some of the private company deals, is reserve value, where there's been there's been a lot of sort of false negative narratives about oil and gas. And this one is related to publicly traded companies, where there was this narrative that large publicly traded oil companies had lots of oil reserves and small ones had disproportionately small reserves. And Vital is a good example of that, where their producing reserve value is in excess of where the stock is trading, at least last I checked. And they have a giant amount of reserves relative to their market cap and enterprise value, whereas some of the larger companies actually trade at a large premium to their reserve value and the quantum of their reserves. So there's this again, it's a heuristic when you hear people sort of repeat things that are just easily measurably not true, right? You can just look at the 10Ks for these different companies and see the quantum of reserves as well as the value of reserves. When people would rather just say negative stuff about companies and not bother looking them up, that's again often a very promising opportunity. And one of the ways from a sentiment and value perspective to validate some of this macro analysis that's showing that the industry is not receiving much love as measured by capital as well as measured by sort of positive sentiment or attention.
I was reading in the newspaper the other day about the Discover and Capital One deal, and the article was talking about how there is some pessimism in the marketplace for publicly traded mergers and whether the government intervention is going to be significant enough under this administration to stop deals in all industries from moving forward. Does that fear permeate in the energy industry as well?
You know, I think in some places it doesn't, and it really should. In other places it does, and maybe shouldn't. So the idea of, for example, the federal government evaluating Exxon's purchase of Pioneer, where Exxon is producing less than 3% of the world's oil, and they're buying a producer that produces about 0.5% of the world's oil. There's clearly no market power going from 3% to 3.5%.
Right.
You know, the measure for these things is 20% or 30% or whatever, where you could begin to have an impact on the market pricing for whatever the good or service that's being provided. So there's clearly no market power. It's total nonsense for various government regulators to be evaluating that deal. It's just an easy one to, you know, subject to there not being something illegal or whatever, to approve it. It's not anti-competitive. It's appropriate, and frankly, there probably needs to be more oil industry consolidation, not less. On the other hand, maybe Exxon should be a little more worried about what they're doing in Guyana, where the Guyanese government clearly wants more operators and more large companies active there, and trying to edge Chevron out of the Hess deal for the Hess's minority interest in that Guyana asset probably is a mistake. And even if they can technically do it legally, it's probably not a great idea if the local government says, hey, we want you to, you know, we want you here and we're glad you're here, but we'd like other folks here too, and we'd like you to sort of keep your proportionate share of your existing highly successful, enormous asset. Trying to edge in on one of your competitors coming in either to that asset or to other areas of the basin, I think is probably a mistake, and I think shows insufficient concern for government intervention. So I think there's sort of, it's not that I'm opposed to that or ignore that, it's more just that I think it makes sense to sort of keep these things in mind. That being said, the Biden administration is going after Exxon for that, for their Pioneer deal. It is under review, and it's unclear whether it will be passed. And so there's a reality, which is they are pursuing it, but I would argue inappropriately so. I think they should be focusing on industries where there's lots of concentration, like the Apples of the world selling 40% of the phones in the US, or maybe more, or the Googles of the world with 90% of search results or whatever through Google, rather than Exxon going from 3% to 3.5%.
Do they look at it on a basis of global production or US?
I think they look at it on a variety of different perspectives, but the reality is that incremental US production has a market impact, at least on the oil side, from a global perspective, not from a local perspective.
Oh.
So local sales of phones matter to local pricing. Global oil production matters to local pricing. It may affect the differentials very slightly, but when you look at sort of the headline number, your headline oil price is more driven by global production and who's contributing to that and so on than by local. But, you know, for phones or other sort of consumer goods or whatever, it obviously matters a lot more who's providing in your local market.
Very good. Any predictions on transaction volume moving forward?
Yeah, I think we're gonna have bigger transactions and more of them.
Okay, nice.
Yeah, I think.
What about in the private markets?
I think there's going to be more private companies bought. I think there's actually, frankly, a limited number of significant size, and I think we're going to see more transactions. And I think there's going to be just a lot of activity, and I think we're going to start seeing bidding wars. And so we've seen a little bit with this Exxon and Chevron fight over Hess, but I think we're going to see more aggressive and more active bidding wars, because I think there's a limited number of assets remaining. And this sounds crazy, I know, and I had a conversation with a friend at a more active sort of trading-oriented hedge fund 6 months ago about Vital and about the Permian, and excuse me, and he thought it was ridiculous and that there were just so many private companies remaining. And you can just see since then there have been like half a dozen or more large transactions, and you see the transaction values rise even though the oil price fell up until recently.
What do you think are the biggest dangers facing the oil and gas industry?
That's a great question. I mean, obviously, electric vehicle adoption is a big threat, but the problem with electric vehicles is that they're so good that the government needs to ban the alternatives to get people to buy them. So I think as long as we remain a democracy, and as long as consumers can also vote, I think the gas-powered vehicle should be just fine. But that is probably the biggest single threat. I think there are other regulatory threats that could really negatively affect the industry. And you look at the pipeline construction in Canada, the TMX pipeline has cost probably 10 times as much as it's supposed to, and they just halted construction for a couple of days because they found a red hawk nest nearby.
Yeah, danger or protected species.
Yeah, but again, like, was it affected? Not necessarily. Was it impacted? Probably not. And they still halted construction of what should have been a $3 billion pipeline that's turning into a $30 billion pipeline. So I think that sort of stuff, it's very negative to the economy, and I think that's a threat to oil and gas as well as to the broader economy.
What do you think are the biggest opportunities for operators, for oil and gas operators?
I think if you're going to buy something, get it while you can.
Yeah.
I think really that it makes a lot of sense to do that. I think organic leasing makes a lot of sense. Exploration has been done too little, and the companies that have done exploration have been enormously rewarded. The EOGs of the world going and finding new oil plays have done a lot better than their peers that have. And
so if you're an oil and gas operator, the biggest opportunity right now is to just continue to spend and reinvest back into your business.
Yeah, but again, I would think the biggest opportunities are with incremental capital, acquiring assets that are desired, because there's a good chance that those asset values will be higher a year from now, not lower, and then even higher 5 years from now. And then I think it's also a good time, frankly, it's always a good time, but I think there's too few companies engaged in organic exploration, because there's just, when you look out at the next plays, there's a few that are, at least in continental US, there are a few that are somewhat promising, but there's really not the next Delaware Basin. And I don't know that we'll find, I don't know that we'll find one, but there's a few exciting ones that I think you guys are involved in. But they're, the early movers are the winners there in a big way.
Yeah.
So you want to be.
So how does the biggest opportunity is, I'll call it acquisitions that are done by companies that are great at capital allocation, maybe. How does that conflict at all with the theme of, a year or two ago for public companies, which was capital discipline, return value to shareholders? We saw, I think, Devon come out with the variable dividend, right? So does that strategy conflict with, in my opinion, it necessarily would. If your one strategy is rewarding shareholders through dividends, and another strategy is using excess capital, I guess, or profits to reinvest back into the business, those two strategies are not aligned, I think.
That's right. I think
so does the narrative have to change, I guess, or the demands of Wall Street on energy, oil and gas companies have to change?
I think the winning strategy from a public company perspective is debt adjusted NAV per share growth. And so however you can accomplish that best using your skill set and your competitive advantage, you should do so. So if you're running a company that has a very discounted stock versus its reserve value, and you have limited exploration opportunities in the area that you're expert in, maybe buying back stock is the best way to deploy incremental capital. If you're a company with a lot of development inventory and relatively little production, maybe drilling a high rate of return wells is the best sort of place to deploy incremental capital. If you're at a high valuation and there's opportunities to do accretive acquisitions either in your area or in new areas, I think that's a great way to deploy incremental capital. I think it really is just, I think this concept of every company should pay dividends and buy back stock and that's it, I think it works for periods of time, but I think there's a lot of risks. And then when you look at companies that have implemented those strategies, I think they have to be very careful with implementing them. And there's a lot of room for slippage or value destruction if there are buybacks at a premium to net asset value, or if there's dividends that are paid out too aggressively.
Going back to the opportunities that you brought up, what strengths or capabilities do operators need to develop to best execute on those opportunities?
That's a great question. I think it's too broad. It's really hard to say. I think it just depends on the company and on their own sort of advantage and what they have available. One thing I was thinking about recently, looking at some of the news on oil traders getting in trouble for various insider things, and then looking at sort of the track record of oil trading at the Exxons and Chevrons as well as the Vitals and so on. I think there's a lot of information that these largest traders and largest oil companies have that often they're either not allowed to communicate or they choose to not communicate in order to preserve their advantage. And when companies like that tell you something, I think as a an investor in public companies or as a operator of a smaller either public or private oil and gas producer or services company, I think it makes a lot of sense to pay close attention to what they're saying, because they just have access. We can do this sort of public information analysis, and we can sometimes be right more than we're wrong, but there's still going to be a very high error rate. When Exxon and Chevron and Oxy and various others of that caliber, Vital, say, hey, there's going to be an oil shortage, and Saudi Aramco goes spend more money and drill more. I mean, for OPEC's history, they were trying to dissuade their competitors from drilling more. When Aramco's CEO says, hey, I think my competitors need to go spend more money on their businesses and drill more, I think it makes sense to pay attention to that. And so whatever, again, like for specific companies, I don't know, it depends on their circumstances. For specific investors, same. But I think it makes sense to be attuned to what folks who have more information or some sort of information advantage share. And you have to filter it a little, right? You want to understand what their incentives are. But when they share information that's contrary to their incentives, or you look at their behavior and you look at the Oxy deal with Crown Rock. I mean, frankly, Crown Rock, it was an amazing private company and did very well for their private investors. But when you look at the asset itself, there was sort of relatively limited. They did a great job of harvesting the highest quality inventory, which meant there was not very much high quality inventory left. And you look at a company like Oxy, which after they had bought Anadarko was sitting on a lot of high quality inventory. And you look at that transaction, then you look at what Vicki Hall has said subsequently, where she's talked about seeing a likelihood of an oil crunch in 2025. It makes a lot of sense. Okay, so she paid $70,000 a flowing barrel for a company with limited core inventory. Again, it was very well managed, and she's buying it. And Oxy is also very well managed from an operations perspective. And so, but you look at the information that they have available to them through their historic international operations, through the oil trading and various other activities that Oxy is active in or has historically been active in, as well as the small set of people that their directly interacting with to figure out what's going on in the market. And there's a good chance that they know better than you or I know about what's happening with oil a year from now.
That's a really good point.
I think
So no ego.
I think it's just important to be
Yeah.
humble on these things. Look, like you're right sometimes, you're wrong sometimes, and there's people that are going to be, and not that they're going to be right necessarily either, but they have access to more information.
Yeah.
So it makes sense to be open to sources of information.
No, that's an excellent point. I hadn't thought about that. I appreciate you bringing that up. Cool. Anything else you want to talk about?
Just sentiment. So oil prices are up 15% or so far this year. It's amazing. I went on CNBC Asia in January, and they put my interview on their website along with like 10 other things about oil, and everyone else was negative or neutral, and I was bullish, and it felt very uncomfortable. And then 2 months later, I did an interview with them a couple weeks ago, and many of the analysts were less bearish. So if we had done this in January,
can you send me the link to that?
I will.
And we can put it in this video, maybe.
I will. I'll send you that picture. I put it on my Twitter, and it's so amazing to me. And I guess I have to step back the comment on paying, or maybe it's a nuance to the comment on paying close attention to these folks running these largest companies. Mike Wirth had been interviewed, the CEO of Chevron, and talked about how he didn't know what oil prices were going to do, and that was the headline. But when you actually look at what he was saying, he was actually bullish oil, and he just didn't know what would happen in the short term. Which I think Vicky had said as well, but by the time Vicky said that, I think a month or two later, oil prices had already improved, and so the headline could be more bullish, whereas the headline for Mike in January had to be a little more bearish. But it was still amazing. They couldn't take what I said and make it bearish oil, so that was the only one. And so up 15% isn't what I'm playing for. I think ultimately we end up with oil prices that are much higher, and oil and gas equity share prices that are much higher, and deal valuations that are higher and much more competitive. But you don't get there without starting up 15%.
It's awesome. Very good, Josh. Appreciate you coming by the office and doing this. It's really nice for me to be able to do these updates with you every year. I think our clients and the folks that get all these notifications and videos and articles and stuff from the firm really appreciate it. We always get awesome feedback. So very good. All right. Thanks, everyone. See you later.
Thank you.